Good afternoon, everybody. It's 3:30, so we want to make sure that we're getting started and being respectful of everybody's time. Want to thank everybody for joining December's edition of Making Sense of the Markets with Chris Kerlow and Team LWC. My name is Mitchell Shields. I'm the Senior Financial Planner with Team LWC. I'm going to be moderating the session today, which Chris has titled Happy New Year. And hopefully it is a Happy New Year for everyone. Today, Chris is going to be jumping into a couple topics. He's going to talk about the recent strong stock rally. He's going to talk about our outlook for 2024, the importance of staying invested, and he's also going to provide some commentary on bond yields. We're going to save all of the questions for the end of the conversation. We should run, roughly 8 to 10 minutes over the primary topics. And then at that point, we'll save some time for questions at the end. So if you're typing into the question and answer chat box throughout the session, I'll read those off at the end of the presentation today. But without further ado, I'm going to pass things over to Chris Kerlow to walk us through the presentation today.
Thanks, Mitchell, and welcome everybody. Thank you for joining us here today or catching the replay online. Happy New Year as a question is kind of the theme for what we're talking about today. We recently concluded our investment committee meeting earlier this week. I presented some of these ideas on BNN, which will come out with the replay as well. But we want to talk about our portfolio positioning and changes we've made, as well as our outlook for 2024 and whether we think, it's going to be a strong year or otherwise. So our standard disclaimer slide. And so we've really seen rates rise over the past year up to about a 5% level that has since subsided, with the 10-year yield falling to 4.18% as of this morning. That sparked a big rally. Fortunately, coming into September, we were still pretty cautious, holding elevated cash levels, deployed a little bit of cash into diversified assets such as Bitcoin and other solutions, but really we're thinking that the 5.5% that we were earning on our cash position was the best place to be. Then in October, we dripped a little bit into the market, adding to equities and fixed income. Furthermore, into November, did the same. That lined up nicely with that pullback in bond yields, which really sparked a risk-on rally in markets. In November, we saw equities advance about 10%. A little bit choppier here in December, but still been a great couple of months. As we move into 2024, we just had the FOMC meeting earlier this afternoon where Jerome Powell kind of echoed his data-dependent outlook and did give some rosy signs in the form of monetary easing, meaning rate cuts at some point in the future. That would be well ahead of inflation reaching their 2% target. It's not like they're going to wait for that to happen. They're going to get ahead of it. Steering that ship does take time. We're still experiencing the lagged effects of the rate cuts from last year, all of which did have the intention of slowing growth, some of which we've seen, some of which may be yet to be seen. That has taken oil prices significantly lower. We're down to about $70 a barrel. From over 90 back in September, we have been adding to that position. We actually reduced that Bitcoin position in favor of oil, as kind of selling high, buying low between those two asset classes. Well, both do have a risk on type of mentality. The Bank of Canada echoed the comments that we saw from Powell today, that they're going to remain on standby to continue to raise rates, but our outlook is that we've probably seen peak rates both here in Canada and on the United States, which has brought us to the highest levels in decades, but something that has us interested in looking at longer-term bonds, because if bond yields fall, that would be positive for the bond market and has proven to be positive for the equity market as well. And while inflation changes have been trending lower, it does create volatility that we've seen in the market. But bonds are back. It's something probably the most encouraged I've been about the bond outlook in my entire career. Having started in the financial services industry in 2008 and watching bond yields essentially go lower over that entire period, up until this year has been a good time to kind of be invested in bonds. And then we've now experienced 3 years in a row. This is the worst decline. The pullback we saw last year, 17%, was the worst since 1788. That seems like an extremely long period, and I'm surprised my team could find that data. But now 2023 marks the third consecutive year of declines, and something that has us encouraged, again, back to that buy low, sell high mentality. You're seeing the average U.S. corporate bond trading at significant discounts, about $86. So that leaves capital appreciation as those bonds approach maturity and roll back towards par. On top of that, you're experiencing the yield. And we've just completed a due diligence of two of our actively managed funds, the PIMCO Monthly Income Fund and the Lysander Corporate Bond Fund. Both have bullish outlooks for bonds in general, but we think that where corporate credit spreads, that's basically the reward you're getting for taking on corporate debt versus government, is trading near extremely low levels. And that could widen out, which would be bad for corporate debt. So we've been actually adding more here to the government bond position and going a little bit further out with duration. Duration is how long until the bond matures. That duration exposure increases your exposure to the volatility and rates going up and down. If they go up, that you don't want as much duration. A lot of managers have been very short duration, including the two I just mentioned. And we think it's time to start adding. We probably would add even more to that trade on, let's say, weakness. The difference of the 10-year yield dropping 80 basis points is a significant move in bond land. And so if we saw a move higher in rates, we would add to that trade of increasing our government bond position and probably going from an underweight fixed income to an overweight. And if equities continue to advance like we've seen since September, we would probably start to take a little bit of profits there to fund that specific idea. That was kind of a takeaway from our current or our most recent investment committee meeting. And all of that has also been a reduction in our cash position. For the past 2 years, we have held elevated cash levels, and it isn't, a pretty interesting opportunity when you're earning 5+% with very, very little, if no volatility. We've brought that more down to a neutral weight and could go underweight cash. Would probably be the next move as we still see opportunity in the market. And that kind of leads into the next slide of a sneak peek into 2024. Expectations are for a step down in global growth in 2024 as developed markets continue their restrictive monetary policy. We think that the market is probably pricing in rate cuts a little bit too soon. And interestingly enough, if we saw a bit of a wobble in the economy, that would probably be one of those bad news is good news for both the stock and bond market, because that would actually increase the chances of rate cuts coming more rapidly into 2024. Right now, they're expected as early as March. We think that's a little bit overzealous. And if those get pushed out, it could be a bit of a negative catalyst. So it's a complicated outlook right now in that market. And we do think that the central bank policy, economic growth, really is guiding the outlook for both stocks and bonds. But interestingly enough, the connection to the economy is maybe not what a lot of people are expecting, meaning that if we did see some of that economic weakness, particularly in the economy as well as the wage and labor market, that could probably motivate the Fed and the Bank of Canada to expedite cutting rates versus hiking or pausing, which would be good for the markets. And so that's something to keep in mind. We have a lot of questions coming from clients. Are we going into a recession? Should we get out of the market? And that's something we want to show, or we're showing here in the chart on the bottom left, is staying invested is the key. Working with us and trusting in our investment acumen to stick handle those moves allows us to stay fully invested, like I mentioned, we play around with our cash levels, but the only reason we had elevated cash levels is because we thought earning 5% in essentially a risk-free way was the right time for that asset class. But to that point, at most, even in some of our more conservative models, we had a 10% cash position, which we were using tactically as dry powder to deploy during times like September and over the summer when markets were weaker and valuations were more favorable. I think that's further it's it's the behavioral side of finance that makes that the most challenging. A lot of our clients, that want to sit on the sidelines now when things are, doing well, but the outlook's uncertain, are probably not going to be in an emotional place to deploy that capital when you're in a deep, deep drawdown that looks like it could go even further. We're showing that on the chart on the bottom right, that volatility is par for the course. You could see the year-over-year returns for the S&P 500 and the max intra-year drawdown. Even in those up years, you do have those big drawdowns, and those are the times you want to be deploying capital, but is one of the hardest times to do so. We're all here because at one point, our ancestors ran away from the lion. And in investing, you need to essentially run at the lion when you see that challenging, fearful opportunity to go in and take it. Is not intuitive to a lot of us. And having done this for our whole careers, it gives us an edge against the retail investor that is investing on emotion, on the fear and greed aspect. Warren Buffett, famous quote, be fearful when others are greedy and greedy when others are fearful, is an extremely powerful tool in what we do. Looking around the world, we've had a position in Japan throughout this year. It's been one of the top performing markets. And we think as their monetary policy normalizes, it's been an area with no inflation and a dead decade, as many have called it. We're still bullish on Japan and think that the yen does have room to appreciate if we see gradual rate increases from that economy. It's a place we like. We've been trimming a little bit on the US side as valuations at 21 times forward earnings aren't overly caught or unrealistic, but not a ton of value at those levels. Deploying in other areas, we actually like Canadian dividend paying stocks. We've been putting some money to work there. Avoiding China, starting to look at some emerging markets, but think it's still a little bit too early. And those are some of the notes from, again, our outlook from the investment committee earlier this week. And I'll just bounce to my other slide. It's been quite the run. The S&P 500 over the last year is up about 19%, but it really is driven by that magnificent seven that you hear a lot about in financial literature. Facebook, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, on aggregate up 71%. We've been fortunate enough to have a position in Nvidia, but haven't had direct equity exposure to the other names, although we do get it through a couple of our growth-oriented funds like the Fidelity Global Innovators, the Dynamic Power American Growth, both of which own a lot of those names. But the average stock, as you can see, is up only 6%. Our US stock portfolio, which we started in September of 22, the end of the month was up about 21% over that time period, which we're happy with, despite when you consider the average stock only being up about 6% over that time of year. Another big catalyst that we're watching is the breadth in earnings. It's been a declining earnings environment for both Canadian and US stocks over the course of the last year. Even this latest quarterly earnings season, we saw a lot of companies guiding lower, kind of coming in, setting expectations down for 2024. Although in aggregate, the total earnings for the S&P 500 and TSX are still supposed to hit record levels next year. And we think that those levels, there's an opportunity to exceed them. And beating expectations is one of the best ways for stocks to do well. As you increase that earnings and the price to earnings ratio, stocks should go higher, even at a consistent price to earnings ratio, because that earning factor continues to advance. So all in all, we're pretty bullish coming into the year. There could be a situation where bad news on the economy is good news for stocks and bonds, as it should bring down bond yields because of the forward expected growth coming in lower. And then that could also spark central banks around the world to start guiding towards the potential for rate cuts, which is another catalyst that we see on the horizon.